Hi, guys, and welcome to the fifth episode of WTW, the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Well, this was an action packed week, okay? Um, we all know what happened. The Fed on Wednesday basically threw a grenade into the mix, okay? Here in front of us, we have the S&P 500 daily chart. I've denoted where Monday starts. This is Monday, Tuesday, Wednesday, the big day, Thursday, and Friday is today. So before we get to Wednesday, which is the big day, let's talk about Monday and Tuesday quickly so that we get some stuff out of the way, because it looks like nothing happened, but there was some retail data that came out. Excuse me, I should say some macro data that came out that was of note, and we should just talk about it quickly here before moving on to Wednesday. So on Monday, we saw the S&P Global Composite PMI, which is a purchasing managers index, but a different style, because normally when we look at our macro here, we look at the ISM manufacturing PMIs and the ISM services PMI. This is a better version of the PMI data set because it's the Institute of Supply Management. It's more detailed, it's more predictive in nature, but they're pretty much all the same. This one in particular is the S&P Global Composite PMI, which is also broken down into manufacturing and services. So that number came in at 56.6 versus 54.9. So it is getting better, even though if you look inside it, the manufacturing went down to 48.3 versus 49.7 previously. So manufacturing is contracting, but the services came in better than expected. It came in at 58.5 versus 56.1. So services are expanding faster and manufacturing is contracting faster, but overall it's going up. So they are getting better. The underlying economic strength of the business sector is getting stronger, even though it's concentrated more on services. Okay, so that's the first thing we denoted on Monday. The next thing is, again, China. China announced that the stimulus wasn't as big as expected. So if you look at the Chinese stocks here, FXI, this was last week. This is the Monday right here. This candle right there. So slow drift down, as I expected, will come until we get more news on the Chinese front. Again, we're holding the same view in China that we held last week and the week before, in that I believe that Chairman Xi is trying to give measured doses of stimulus because they already have a lot of debt and they don't want to spark more inflation and increase their debt as well by issuing a big package. But as you can see, the Chinese market is way down from its highs. Way down, like over 50%, or maybe 40%, something like that. It was at, let's see here, it was at around 55 and now it's at 30. Around 50%. And they need to stimulate if they want to get it higher, or they have to really suffer a big crash, and they don't want to do that. So eventually we're waiting for the big bazooka to come from Xi. He's going to give measured doses, nothing's going to happen. Look, people are expecting a big move, nothing. Expecting a big move, nothing. So eventually he has to throw out the big nuclear bomb, the big bazooka, and that's when we'll probably have a play in the Chinese market, but not until then. Okay. Another thing that happened is that RIOT blockchain, this stock right here, RIOT Platforms, terrible stock, but it announced another. It's going to raise 594 billion via a convertible note, and they're going to use the proceeds to buy Bitcoin. So they're just following the strategy. Um, let's just see Bitcoin here. And as you can see, let's mark it here. This is Monday right here. Okay. So Monday, Tuesday did well, and then of course it got crashed after the Fed meeting. So they're just following the Bitcoin strategy. And as you can see, well, let's talk about it right now. As you can see that Bitcoin, it crashed after, but it's still holding fairly well, even though this clean break has been crashed. This clean uptrend has been broken to the downside. It's not a crash, it's just a fall, and it's hovering around this consolidation area. Okay. It's understandable why it did it, because like we said before, Bitcoin is not a hedge. It is a levered play on the market, so it will go down when the market goes down. Okay. And it will go down probably more when the market goes down. So just keep that in mind. Everybody now is trying to follow the Michael Saylor strategy. Okay. So that hasn't changed. So let's go now to Tuesday. Back to the SPY. Tuesday right here was another. Let's open it up. It's basically a flat day. Nothing happened. Okay. But what we should be noting here is that a slew of macroeconomic data came out. Okay. Like retail sales, industrial production, business inventories, manufacturing production. It was a whole slew of things, and they're supposed to be important, but they are not. You can just ignore these things because none of them are relevant to our macro data. The macro data is very particular, and we only focus on things that have some kind of predictive value, besides the GDP, which is lagging. And what else did we focus on here that's lagging? We had the GDP and the jobs. Those are the two things that we focus on as a confirmation of our strategy. Okay, we don't use it to make predictions, but we use it to confirm that we are in a situation that we thought would happen 1, 2, 3 months ago. Okay, so, and it is confirming it, as you will soon see when we look at GDP and initial claims for the jobs reports that are coming out, that will come out on Thursday. Okay, but as Tuesday is concerned, the macro data that came out could be completely ignored. Okay, so basically Monday and Tuesday, nothing really happened because everybody was expecting this day right here. Okay, so let's get to it. So what happened? Well, first, before the big day, something that came out in the morning that is relevant are building permits. Okay, now that is something that we have to look at. Okay, I forgot to include that initially in my first WTW1 podcast of the reasons to stay bullish, because it is important. It is a leading indicator. Okay, so I will add it here as a 13th point. Okay, right after the Fed sentiment and technicals. Okay, so building permits, it is important. The trend matters, as does the actual number. Okay, so let's visit that before we get into the big news first, because this is important. So let's go to the building permits. You can find that. You can go here on Trading Economics, which I like. It's a great site, and you put Trading Economics US building permits, and it'll give you this chart. Okay, it goes all the way from 1960. Okay, and as you can see, building permits rise when the economy is expanding, like from 2009 to 2020, and it falls when there's a crash. Okay, but what this doesn't show you is the recessions and how it leads. Okay, so I like to use the FRED database, which is a Federal Reserve database. Everybody can access this. It's free information, and so is this. You can go to Trading Economics. But when you want a quick look, you just go for the 1 year. You can see the quick look, like the building permits on Wednesday came in at 1.5 thousand versus 1.42. So they're rising. More building permits are being issued. This is important, and it is a leading indicator because building permits lead to housing starts, which then lead to housing completions. And that cycle takes about 3 months, okay, maybe 6. Okay. So you know that in 3 to 6 months, when you have higher building permits, you're going to have a higher housing sector. So this does lead the housing sector, and it does lead the economy. So you can know in 3 months things will get better if you see a steadily rising building permit chart, like if we have here. See, steadily rising in 2020, building permits were issued, so we had a boom, okay? As was throughout 2015. Let's go to the max. The entire from 2009 to 2020, building permits were increasing, and the housing sector did well, and by extension, the economy did well. So, if we go back to the Fed, you can see how important they are, building permits that is, because now you can see in the shaded regions, this is where the recession started. And as you can see, right before the recessions, building permits go down, okay? Right before a recession here, building permits, 1973, they started going down. Okay, here was 1990-91 recession was forecasted by falling building permits. Okay, so as you can see, they lead recessions, but it could be 6 months to here, almost 2 years. The 2006, see, they started falling in 2006 of February, and then we got the recession in 2008. So this was the longest one, the longest lead time. Okay, but you know that they're going down, something ominous is happening. Okay, not right away, but but eventually. Okay, and you can see that the absolute number matters, because look, we had about 1,415, 1.5K, and here we had 1.4. If it stays around these levels, as you can see, the average is probably like 1.4 around here, 1.4K to 1.2. And of course, it's in the thousands, so it's 1.2 million, 1.4 million. Okay, this is about the average. So it's higher than the average, and it's not really falling per se. I mean, it is falling from 2022, but 2022 we already had the recession, the drop of 20%. So here they're not really falling; they're holding, and there's really nothing to worry about at this stage with building permits. Okay, so that's another thing we should be looking at. And it confirms our bullish thesis that they're not collapsing and they're staying at 1,400. It's an average level. It's not really telling you much, but it's certainly not forecasting a collapse anytime soon. Okay, so let's go back to the chart at S&P 500. We're at Wednesday. So now Powell comes out, says that basically says what everybody was expecting. He was saying that we're going to cut 25, but we're going to sound a little bit more hawkish. We don't think that, like the Fed Watch tool here. Let's go to the Fed Watch tool. Fed Watch tool. Except, let's go now to December of next year. So this is the forecast of next year. He's expecting two cuts. Okay, the vast majority of the market is expecting 2 cuts. 2. So they're a little bit more hawkish than they were before. Before there was a slight chance of 3. Now there's probably 2. Okay, so the odds of the 3 went down and the odds of the 2 went up. So this is what they're expecting in 2025. Are we going to get that? Who knows? That's just expectations. Okay, these can change in 3 seconds. I don't understand why the market put so much emphasis into it, and it was expected. So, at least hinted at. Okay, so the market tanked, didn't like this. And consequently, as the market tanked, the VIX ripped. Okay, it went from literally 15 to 27. Okay, so let's talk about the VIX. This is important. Okay, as you know, the VIX, if we go back to our macro factors, which is the macro backdrop that we always talk about, the VIX is number 5. VIX is below 20, 25. This means risk on. Okay, so it shot up above that. Okay, it shot up to 27 about. Okay, as you know that around 20 to 25 area, historically speaking, they're usually highs. You're starting to get into like panic mode. Okay, so here we're at over 20, 28. Okay, so this is panic mode, And at the same time, while this was going on, the market tanked basically what? This is like a 3% drop. Okay? It's not that much. A 3% drop, the market, VIX, which is the fear gauge, rips to 28 above the historical highs. Okay? Rips to 28, and at the same time we have sentiment, which goes here. Fear and greed was like around here. Okay? In the fear. Now this is fear and greed as of Friday. It's at 28, still at fear. Okay. I like this index a lot. It's free, and it's an amalgamation of many things: market momentum, stock price strength. You can look at it for yourself, but basically, it's a contrarian indicator. Okay. When it gets really extreme, you're probably gonna have a bounce. Okay. So we have extreme sentiment. Okay. After a 3% drop, VIX spiking to 28. Okay, massive fear. Just because Powell thinks there might be just 2 cuts instead of 3 next year. Okay? Strange, but if you look at it, if you think about it, last week we had the inflation numbers. We had the CPI and the PPI, if you remember. And the CPI came in basically in line. And the PPI, which is not that, it's important, but it's just like, this is what producers pay for their goods. It came in hotter than expected. But that's not a wide measure of inflation. The Fed doesn't really look at it. I mean, it looks at it, but doesn't base its decisions on it. What it looks at is core CPI and also more specifically, core PCE, which is coming on Friday, today. But we'll get to that soon. So basically the inflation numbers are in line, slightly hotter on the PPI, which is not even looked at. And people reacted like this when Powell announced, we might get we might have to keep rates up. I mean, just cut twice instead of 3 times. It's crazy. So again, we're going back to the same theme that this market is hated. This bull market is hated. People have one foot out the door. They're very skittish, very sensitive when it comes to an inflation measure. If it's slightly hot, they panic. And they send yields skyrocketing. And the VIX at 27. Okay, with a huge drop here that results in almost at extreme fear. And in this morning, like on Friday morning, you'll see it actually dipped to extreme fear before rebounding today. Rebounding on Friday, because that's where I'm recording this on Friday after market. So again, it confirms the fact that everybody has one foot out the door. But this is beautiful if you're long, because we are still bullish. Nothing has changed. Okay? And as you can see on Friday, we had some good news on inflation, but we'll get to it later. So today, on Wednesday, huge drop, massive fear. All the indicators dropped to fear. All the sentiment went to fear. And nothing really changed on inflation. Just because Powell thinks that maybe in 2025, which is a year ahead, there's only going to be 2 cuts. He's basically jawboned. He jawboned this. Took advantage of people's skittishness to inflation and rate cuts, which is assumed. And this is the result. So it goes to show you we are probably not at highs. I'm still bullish, okay, given this. And if you follow me on Twitter, I mentioned this on Wednesday, that we have to wait till the dust settles, but we are very, very close to a bottom here. I'm saying it. And I started buying a little bit. Okay, but mostly I started buying on Friday. We'll get to that later. So this just confirms the fact that people are still scared, still skittish. They took their sentiment all the way down to a fear, almost extreme fear, in the middle of a bull market, with inflation not really that bad. Okay. Again, I'm going to reiterate what I think about the inflation, okay, and the U.S. 10-year yield, because that is what's ripping it higher now. Things are ripping higher, and this is just an inflation. Like people are ripping the yield, the U.S. 10-year yield higher because of fears of inflation. But I don't think we're going to get inflation when you don't have this kind of massive money printing that we had. Okay, people think that tariffs and Trump is going to increase costs and inflation. I mean, Trump's first term, he increased tariffs probably more than he's going to do now. Okay. By the way, half of what he says is probably a threat. Okay, just to negotiate. Okay, he's not actually going to do it, but even if he does, he did it in 2016, and inflation was at 2%. Nothing happened with inflation. Okay, so this is pure fear of inflation, and that's why people have one foot out the door of this market. But this is beautiful for us if we're long, because this resets everything to super fear. Okay, in the fear and greed index. So this allows this market to like rally again with more fuel, because now people, I'm sure here when they were selling, there was a lot of leverage longs and they got out of it. Okay, that's what exacerbated everything. Okay, so that's my view on what happened on Wednesday. It was a great opportunity to wash everybody out, clear things for the next big move up. Okay, just like it happened here. Like we had fear. The last time we had extreme fear, by the way, was here. Anybody remember this? The August 5th, 6th crash? This was extreme fear. Okay? Tanked it from here, from 553 on the SPY to 511 in like 2 days. Okay? You have the same extreme fear here on Friday. It reached that. Not on Wednesday. Wednesday was just middle of fear. But here on Friday, it went to extreme fear. And look what happened after. You have 2-3 weeks of massive rippage, which is what I suspect will happen in the coming weeks, especially since we're in a very bullish seasonal period for the market. Okay, after getting washed out, I think we're going to get a big snap back move higher. Okay, so that was for Wednesday. What happened on Thursday? Thursday we always get initial claims. Okay, and that is good. We have to see here. Initial claims came in at 220. Okay, let's look at initial claims. Initial claims dropped. Last week, we had it at 242,000, and this week it was at 220, so it dropped a lot. That's what you want to see. Initial claims going down means that people are not filing for unemployment. The economy is going to do all right. There's no panic. Okay, let's look at the max trend again. Oh, let's just go here. Nothing. Everything's staying steady around the 220 mark. That's like we said, the economy is doing okay. Nothing to fear. No super inflation in terms of my view. And nothing to fear here so far. Okay, so on Thursday, we had the initial claims come in at 220 versus 242 last time. Okay, this is good for growth. And we look at initial claims, it's better. Initial claims because they lead. Okay, they lead the jobs. They lead the jobs numbers that are going to come out at the first Friday of every month. If you look at initial claims, you'll get a sort of a good idea of what the jobs numbers are going to be. So to me, it looks like the jobs number is going to be the same as it always was. Nothing special coming in January. Okay, so let's go back to Thursday. What else did we get? We got the Philly Fed business conditions and the manufacturing index. You can ignore that. Everything else, that doesn't really do anything for us. We have better measures to look at, better macro to look at. And another big thing that came out is the GDP. The GDP growth rate was at 3.1% versus 3%, like we said in our macro. Reasons to stay bullish, GDP is holding between 2 and 3%. It's actually a little bit higher. Okay, 3.1 is the same thing. So GDP is holding up. Initial claims are down, which means the jobs are going to hold up. And inflation came in line. The CPI last week came in line. And, well, tomorrow, which is Friday today, you're going to see what the PCE did, because the PCE is the inflation measure that the Fed looks at, and that's the one we should be paying attention at the most. Okay. In fact, I would weight the core PCE as the heaviest inflation a metric that you should look at, and second would be the core CPI. Those are the two that you should be looking at that have the most, that the Fed is looking at the most. Okay, so on Thursday, which is the continuation, the market opened up from a little bounce, but people were still scared and they sold it off all the way down. Okay, so now let's move on to Friday. This is the big day. Okay, opened up lower. This is crucial. Okay, this got everybody to dump. It's like the final dump. Got everybody to dump out of fear. It brought the fear and greed index to 22, which is an extreme fear. Okay, we hadn't seen that, like we said, since August 5th, that panic sell. Okay, so it got people to sell panic and then close higher. This is extremely bullish. I think we've reached the bottom, and everything else is going to go higher in the next 2 weeks because of this. Okay, and they opened it up because of fear of a government shutdown. Okay, so we're going to get all this news about a government shutting down. It's all positioning, it's all negotiations, and it means absolutely nothing for trading. So forget it. In fact, you should use it as a way to position yourself, get long if you're bullish, because it always resolves to the positive. Excuse me. And of course, the big news that came out on Friday, as I mentioned it before, was the core PCE index. It dropped to 0.1% month over month versus 0.3%. That's a huge drop. So the core PCE is dropping massively. Okay, so that is supportive of our falling inflation. I think inflation rates are going down because as long as the Fed isn't printing, I don't think the Trump tariffs will do much on inflation. And the economy is humming at 3%. That should get goods pumping into the economy, which would lower the inflation rate because more production lowers the inflation rate since no money is being printed. It's gonna be like the Trump 2016-2019 period. Okay, I have no fear or very little fear that tariffs are going to increase inflation. And if that's the narrative that spiked up TLT or dropped TLT but spiked up the US 10-year, which is just a mirror image. Okay. Spike this because of Trump tariffs? No way. I just don't see it. So, back to SPY. The big news is that this drop on the Fed is a perfect setup to go long at extremely low situation, at extremely low sentiment, high fear. I mean, I can feel people panicking on Wednesday and Thursday and even today. Okay, panicking. This is when you want to go long, especially when your macro is still bullish. Okay, you might have to look at other things to confirm this, like VIX. Just look at it. Ripped higher than expected, now well within the range, and whenever it does this, it drops for the next 2 weeks. Whenever it spikes up here, drops for the next 2 weeks. Spikes up to the 25 area, drops for another 2 weeks. This is very, very bullish. Okay, look, it spiked up, dropped again. I expect another all the way back down to the 13, 14, 15 level in the coming weeks. So all of this panic, all of this brouhaha, all of this emotion is setting up the markets for another snapback move higher. Okay, so for me, stay bullish. Don't panic. It was a very exciting week, the week of the 16th, and I'm looking forward to next week. So given all this, stay bullish.